if we can stay focused when others are distracted, we'll probably deliver a lot for our clients. The hardest thing to do when you have the industry going through such rapid change, your company going through change with technology, you have geopolitics that are upsetting and causing greater volatility, the hardest thing to do is to stay focused.
Hello and welcome to Buyside Views at TD Securities. I'm your host, Andres Rincon. For this first recorded version of Buyside Views, we have the pleasure of doing it live here in our beautiful TD Terrace building. And we have a beautiful group of individuals, wealth advisors and gatekeepers joining us today in this recording. So I'm very excited to have you all, and thank you once again for making the time to be here today. Look, for this first live version of Buyside Views, I wanted to bring back one of my favorite guests I've had on Buyside Views. I wanted to bring back one guest that I had a very good conversation with and I really enjoyed. So I could only do it with Mike Gitlin, CEO of Capital Group. Mike, welcome back.
Thank you for having me again. I appreciate it.
Mike, did you know that you are our first repeat guest?
Wow, and the first live guest. Those are two firsts.
That's
I'll
right.
take
So
it.
I'm
Thank
not sure if you're the lucky one or I'm the lucky one, but
Let's say both.
But given that you manage $3.3 trillion in assets globally, I'm going to say obviously that we're the lucky ones to have you.
Thank
so
you.
for that, thank you for being here again.
Well, I appreciate it.
Why don't we kick it off with a question that I asked you in the first time you were here, which is just about sports. I asked you which sports team you supported. Coming from Connecticut, now living in LA, I thought that you were going to say the Whalers or something along those lines. But to my surprise, you said the Toronto Maple Leafs, and they were really good last year. Not so much this year. So you're still a Leafs fan?
So it was a journey. I grew up in Hartford, so I was a Hartford Whalers fan. And when they left, sadly, my nephew, who was 2 at the time, picked the Leafs. And so we've been Leafs fans. He's 32 now. We've been Leafs fans for 30 years. And I always say there's 4 seasons as a Leafs fan. You go in the summer, and it's the height of optimism. You get into the fall, and it's sort of faded hope. You get into the sort of the early winter, and it's rising pessimism. And then you get to now when we're out of the playoffs, and it's utter despair. And then it starts again.
Yeah.
And it happens every year. So that we are in the despair phase and looking forward to the optimism phase.
Well, on the flip side, you still have the Dodgers.
We do have the Dodgers.
And they broke our hearts last year.
Yep.
But they're a lot less volatile than the market. So at least you have that going for you.
That is a true statement.
So on the markets, 2025 versus 2026, what are some of the key differences you're seeing in the markets today?
It's interesting when you think back to 25, which seems like a very long time ago now for all of us for so many reasons, but you think back to 25 and so much was happening that was really positive. Rates were generally accommodative, very positive. If you look at inflation, it was coming back down towards target, not there yet, but directionally right. If you look at earnings, very strong for companies around the world, not just in North America, but around the world. GDP growth was positive. The US dollar was weakening a bit. Non-dollar currencies were gaining. And then in 2026, everything sort of stopped at the beginning because of the war. And what was working then was oil and the US dollar. 2 things were working and everything else wasn't. And now you're sort of coming back to a little bit more of a calmer period where people are trying to assess the long-term impact of the war and on energy and on inflation and on growth. But at the same time, earnings are still coming through. And what's interesting is the fear trade of having too much cash is everywhere. Everyone's got too much cash. And I've started to see people now being worried about not being in the market as opposed to being in the market. And I think that's because, and I'm sure we'll talk about AI, but I think it's because over the longer term, people realize companies will be more productive and have higher profitability. And it's hard to not own those because you're trying to time the price of oil.
Right.
And so it's very different backdrop this year. But at the same time, I think that the belief that earnings will be positive over the long term has the markets driving higher than the geopolitics would probably allow you to believe.
That's right. And what about Capital Group? Are you doing anything different this year versus last year?
I wouldn't say, again, Capital Group within the capital system, folks have autonomy to do what they think is best. I wouldn't say folks are doing things different other than our investment professionals finding different opportunities for when folks decide they want to just rotate out. If you remember some of the AI sectors 3 to 6 months ago, one thing would come up and the whole sector, software, would be down 20% overnight, or commercial real estate. It was believed quickly that no one would ever work in a building again because of AI. And the sector falls 15 to 20% in 3 or 4 days. Our folks are finding opportunity in the panic and the chaos for the next 5, 10-year outlook. So I would say that from an investment perspective. From a non-investment perspective, I'd say what we're doing as a company differently is testing and learning more.
Okay.
With technology, with our own brand and how we're recognized around the world, folks are being more creative. We're testing and learning. I think part of it was us as a management team giving them permission, saying, please do that, and you won't have to ask for forgiveness or permission. I wrote a note about that to our 9,500 associates recently. We did some branding work in Geneva. Okay. We put our name on the top of a building, which Capital Group never has done before. And I said it was a moment of pride watching it go up. And it was great how those creative associates thought of that as an opportunity to extend brand. So I'd say test and learn is something more that we're looking at.
So keep the strong culture, but evolving with the times.
Yeah, I'd say that's right. I mean, when people say, well, what do you do to maintain culture? I stop them and say, we're not trying to maintain it, we're trying to improve it. You maintain core values, you improve culture. So our core values, long-term, integrity, diverse perspectives, community, client focus, those 5, those can withstand the times. You're trying to say on the culture, how do we get it better? How do we get quicker at doing things?
Right.
How are we more agile? How are we trying to extend our brand? How are we trying to do more for clients? Some of those things you want to get better and better at, and you don't want to just sustain.
That's right. So let's touch on the capital system. You mentioned it really briefly there, and your multi-manager capital system approach is obviously one of your key differentiators, and you've talked about it in our previous episode and a lot of the social media and your podcasts. But sometimes it can be a little bit more complex to explain. So what is the simplest way for our advisors here that you can explain to them and to their clients the capital way?
Yeah, I would say the capital system's been around a long time. 1958, so yes, before me. Some of you were wondering. But 1958, and the capital system, our founder at that point had just returned from medical leave because he had had a heart attack.
Right.
And he came back and said, you can't have key person risk. So the easiest way to think of the capital system is make sure you have no key person risk in your business because that's not good for your clients. So we have 3 sort of hallmarks of the capital system. Collaborative research. Every single analyst manages money. That is super different. Walking the halls to portfolio managers and say, buy this and sell that is very different than having skin in the game. So everybody manages money, whether you're a portfolio manager or an analyst, and there's no hierarchy. Diverse perspectives. All the portfolio managers get a slice of the portfolio, and they have an opportunity to express their highest conviction. So what I love to say is you're not left with one individual's 300th best idea, which is really important because when you get to 297, things are fading pretty quickly. And the last one is long-term. We measure our analysts and portfolio managers first and foremost on their 8-year number. Not their 5, not their 3, not their 1, their 8-year number. So you have analysts with skin in the game who have their highest conviction. You have everyone's portfolios open. Everybody can see it. You have portfolio managers with their highest conviction with the same benchmark as one another, but different best ideas. And you put them all together, and you're not left with over-diversification of one person's 300th best idea, and you have everyone focusing on long-term results, not short-term results.
And Mike, why hasn't it been replicated by others?
It's hard, and it's not cheap.
Right.
I mean, it's expensive because you have more folks managing money. and that's difficult. And there's ego involved when you have this lack of hierarchy. A lot of folks love hierarchy. They love bureaucracy and they love hierarchy. And if you like both, you should not work at Capital Group. You should work at the companies that also love that.
Yeah.
For us, we hired a lateral hire portfolio manager once. I will not mention the person's name. And when we were interviewing him, I said, the analysts don't work for you. They're managers the way you are, and they're partners of yours, and there's no hierarchy. And he said, yeah, that's great. I said, no, I think you think that. And then they'll come and you'll still think they work for you.
Right.
And it took a few years to work that out of the system for that individual. And now that person is rated by the analysts as one of the best portfolio managers. So they figure it out over time. It's hard to replicate because a number of people you have to check your ego at the door. Everything's open. You have to have this trust and transparency. And it's not easy to just tell people you have to do that. You have to really grow up in that system.
Right. Look, I wanted to switch gears a little bit and talk about your travels. We're here in Toronto. You have the CN Tower. Beautiful view, CN Tower right behind us. And you were in Asia not too long ago. So you travel quite a bit and you talk to regulators, you talk to peers, you talk to clients quite a bit. So what are some of the key trends that you've identified they're talking to you about when you're talking to investors globally?
Yeah, I'll give you two. One is a portfolio issue and one is a macro industry trend. The portfolio issue is everyone's got too much cash. And cash never wins over long periods of time. And I do simple math for myself, not for you. But the simple math about cash, if you look over the last 30 years, effectively, you can round up or down depending on where you are in the world. Cash does 2%, bonds do 4%, MSCI ex-US did 6%, MSCI did 8%, Canada did about 8.5%, and the US with dividends reinvested did 10%. 2, 4, 6, 8, 10. Over 30 years. Over that 30-year period, you had two 50% equity bear markets. Trying to time things is impossible. So one is, in the wealth management world, there's just too much cash. And the higher the market goes, the more the cash hurts. And then you have a little bit of a decline, and then the cash goes back in, and it goes back up again, and it's sort of de minimis in terms of reinvestment. People have to stop trying to time the markets. Since 1926, over the last 100 years, the equity markets have done about 10%. We've had a few things happen since 1926. Great Depression, 15 recessions, world wars, pandemics, global financial crisis. Trying to pick any individual date when you were going to say, I want to get off that annualized 10% journey and try to go overweight cash to time it, didn't work. But everyone does it, and we're too much cash. On the industry side, folks in the world of wealth and folks who do diligence on asset managers are having a hard time because M&A is happening. You've seen it with some big deals announced recently. We talked about it before. Last year, you had more asset management deals occur at any point in the last 45 years. This year, I think there'll be more again. So you're trying, as someone who's doing diligence on asset management companies, to hit a moving target. Then the M&A happens, and then you wonder, during that period of the Hunger Games, who's going to be left doing what? And it's very confusing to try to assess what that manager is able to do when so much is happening.
Right.
So consolidation in our industry is definitely occurring. It's in all the numbers you see. And you're managing two things. One, how to get folks invested and stay invested, and then how to assess my partners and who can help on a persistent basis and not be disrupted or distracted by M&A.
And actually, given your size, that actually works to your advantage in that respect.
Well, it does. I mean, we're not acquiring anyone, and we're not selling ourselves. So we like to think of that as a competitive advantage, that we can be stable.
Yeah.
And other folks have to contemplate both. How do I acquire to be relevant, or do I sell to become relevant? Those are very distracting type things companies have to think about. we're able to stay focused. And I tell folks, we announced a large investment in our North American client group a couple months ago, and it was during a period of time when most folks are cutting. And we're able to, we had that conversation internally, do we publicly announce this investment? And the answer was sure, let our partners know that we're investing in the business for them. We don't have to be shy about it. And we can do it. We have the financial wherewithal to do it. And we can help our partners even more. It's a great advantage. Why not take advantage of that advantage?
Right. No, thank you for that. And you know what I find also fascinating? So for those of you that know me, so I had the ETF sales team at TD, and obviously beside me is one of the largest active managers in the world. And you know, if you go back 10 years ago, maybe this conversation wouldn't have been mainstream, but it is today. And that I find really fascinating. If you look at flows in actively managed ETFs, it's ballooning. It's growing like crazy every single year. And just to put it into perspective, last year in Canada, the AUM of active ETFs in Canada is about a third of the market, but 50% of flows last year was in actively managed ETFs. We're a leader in actively managed ETFs here in Canada. But in the US, it's growing really, really fast, especially now with ETF share class. We have just AUM is over 10% or so in actively managed ETFs, but last year flows were in a third of the market were in actively managed ETFs. So that's an impressive number. So with that in mind, how do you see actively managed ETFs and strategies more broadly?
Well, look, I'll say a couple things. One, the base of what we're talking about is how to deliver intellectual capital. ETF, SMA, separately managed account, our institutional clients, traditional mutual funds. For us, we're not super judgy. It's how does the client want to consume it, and how do you make sure they have it available to consume the way they want? The ETF adoption, we're seeing it here with our 4 ETFs in Canada. We're seeing it in the US with our 27 ETFs. The flows are pretty significant. I mean, right now, we're seeing an average net flows in our US ETFs of about $1.5 billion a week. So people are adopting the vehicle. There's less preferential treatment for taxes in Canada than there are in the US. But globally, there's greater ETF adoption, there's no doubt. And I think you'll see that continue. I don't see any sign of that slowing. You know, I do, back to the comment on trading versus investing, I do worry about some of the innovation around ETFs and inverse this and triple lever that. Again, you're back to game playing when you do that as opposed to investing. Right. But can ETFs sit at the core of our portfolio? And some advisors prefer them for their clients for certain reasons, absolutely. And the growth rate is going to be significant for the next decade, not for the next couple of years.
And how do you think about them within the broad portfolio construction discussion? Where do they fit?
Yeah, I mean, so to us, we think they fit at the core. If you're thinking of ETFs as, well, they trade a lot more, it's the old mindset when ETFs were largely passive and they were largely used as trading or hedging vehicles. Now with active ETFs in Canada and in the US, they should sit at the core of our portfolio. Stay away from the gimmicky ones. Try to figure out how they can sit at a core and how they can add long-term results to your portfolio. And I think that's just, again, an education. Still, there's a lot of folks who think of ETFs as passive. I mean, the active industry, for the first 25 years of ETFs, largely let the actual vehicle become synonymous with passive.
Right.
Now that we and others are offering an active experience, you're seeing that flow, like you said, where it might be 10 or 30% of the installed base, depending on where you are in the world, but the flows are so much higher.
That's right. And actually, tying back to flows, one thing that's really interesting here in Canada is a lot of the advisors have CRM3 to deal with now over the next year or so. And a lot of the advisors will now have to show total cost of ownership to their clients. So in this environment of higher fee sensitivity, how do you think advisors can position active strategies within portfolios?
Yeah, I think over the long term, you should just simply assess, can the manager, and I always say this to our team internally, the active industry, it's not a union. Like we don't all carry cards that say active industry union member. We're not a union of active managers. Some active managers shouldn't be hired. If you look at their long-term results, they haven't been able to beat either competitors or benchmarks after fees. An advisor should assess that and say, I might be able to find a better manager. I mean, I look at our long-term results and I'm super proud of our team. If you look since inception in our equity and fixed income strategies, more than 85% beat the benchmarks gross of fees and between 75 to 80% net of fees.
Wow.
And so can over the long term, and obviously everywhere it's been difficult in the last decade to beat equity benchmarks. If you believe in a market broadening, which I think many people do, it's a great opportunity for active managers. But over the long term, can the manager beat other active competitors and benchmarks after fees? If those proof points show, you should entrust your capital with them. And if they don't, you shouldn't. And I think so you have to look at it from a net of fee perspective when you're looking at outcomes and results.
And you mentioned obviously some of your outperformance, and actually in fixed income, you have quite strong outperformance, and not just in terms of returns, but also in asset gathering. I think you've doubled your lineup since 2018, I believe, originally in mutual fund land, but now a lot more in ETF land. Talk to us about that growth in fixed income in your lineup and how it fits in the portfolio.
Yeah, so fixed income in 2015, and we always measure ourselves by outcomes, not assets. Some folks in the alternative world, we partner with KKR. I can talk about that if it's interesting later. But some folks in the alternative world keep talking about AUM targets, asset under management targets. If I were sitting in an audience and they were talking about that, my question back would be, I have a question, what about results? Because I benefit from results, not your assets under management. So I'll mention our assets, but only in the context of your question. I always refer to outcomes more than assets. We manage about 650 billion US of fixed income assets. 10 years ago, we were about 220 billion. So we've seen a lot of growth. I think, in the rate environment you see globally today, you look at someone and you say, well, what are your capital market assumptions? And they'll generally say 6-7%. You look at a multi-sector income strategy and you might be yielding 5.5%, 6%. And that might be 50% investment grade. So I think there's such an interest, and we're seeing net flows into fixed income again. Even if credit spreads are tight, the risk-free rate is so high that the combination of the two provide good income. So I think you can get a long way towards your capital market assumptions by owning fixed income. And then you have the equity risk and opportunity as well. And we're just seeing a lot of interest in 5 to 6% yielding securities. It's a lot different when you're at zero interest rates and you're not generating a lot of income. 5 and 6% is pretty good income to be able to generate.
And actually, you're more successful from an asset gathering. I know you said you don't like to mention assets under management, but you're one of your more successful ETFs here in Canada is a fixed income ETF.
Yeah, our multi-sector income ETF in Canada has generated a lot of interest. But I hope the folks who own it now and who will own it 5 years from now will appreciate the X% annualized total return, and regardless if it's 3 billion or 10 billion in AUM.
For sure. Last time you were with us, you mentioned the global survey that you have with advisors across the world. I don't remember the exact number, but there were more than 6,000 advisors that you survey every year. And this is related to really practice management. You dig deep into what makes their practice successful. Maybe you, for the benefit of our audience here, can talk to them about what makes a successful investment advisor practice.
I think advisors have a hard job, harder than I have. And I say to them all the time, and we do have the data, as you mentioned. We have a lot of data on financial advisors. And if you look at what makes the most successful financial advisors, they do a handful of things well. What are the kinds of things? They think of their business like a small business. They think of scale and creating that business and the CEO of a small business, and that's their mindset. How do I create scale and succession in my business? They think about client acquisition as a real thing, not someone introduced me to someone. That's a referral. That's not a program around intentional client acquisition. They think about retirement plans. Have I formed a retirement plan with my client? Instead of just getting invested, what's a real plan for them in retirement, for them and their families in the next generation? Right. The client experience. My financial advisors talk to my kids as much as I do. And I think that's a good thing. And I talk to my kids a lot, by the way. And so, what about that client experience? Are you calling them as a reactive moment? Are you just answering the phone when they're worried about the world? Or is it a really good soup to nuts client experience? And then the last one is they measure themselves and they hold themselves accountable. Every day is not just a day. It's the accountability around measuring how many meetings have I had? How often have I reached out to my clients? When I'm thinking about branding, what has been the impact of the branding I've done in my own business? Once you wrap that all together, you're not just a portfolio manager managing assets for some people. You've created this holistic ecosystem where you're helping change people's lives, and you're investing in your business as a CEO in a very serious way.
Interesting. I wonder what they're talking to your kids about.
I don't know. That's a good question. Probably about me and when I'm going to die.
Mike, in our last conversation, you mentioned AI, and we discussed how it's giving more information to your PMs. It's equalizing the flow of information for the firm. But since our last conversation, AI has really evolved quite rapidly. I'm sure within Capital Group, also within TD. Perhaps you could give us an update on how Capital Group is using AI today.
Yeah, let me do it in the context of investment management. Everyone knows all the stories around service. And in the client group and in marketing and preparing for client meetings, I don't think that's super unique, although I think we made great strides there. But let's talk about investment management. One of our analysts got on a call the other day, and the call is titled, "Cool Things I'm Doing with AI." So I logged in, and the analyst said, "Let me tell you how I'm using Claude." And he did this for all the analysts and portfolio managers, and it was over 15 minutes. I'm listening to him, and he said, "I've trained Claude to be a great research assistant. So I have to give it information about me." And what did I say? I said, well, I'm a long-term investor measured first and foremost on my 8-year result. And then I said, my coverage is telcos in Latin America, Africa, and Europe. And I have a geographic bias in my mind to Europe because I'm based in Europe. So make sure you're really thorough with me outside of Europe because I acknowledge that bias. My valuation framework, I like to focus on return on invested capital, discounted cash flow. From an idea perspective, 10 billion market cap's the sweet spot, 1 billion's the minimum. And it goes through this, don't answer a question just because of the way I ask it to you. And here's the thesis on my current portfolio. I have 15 stocks in my analyst portfolio. Here's the current thesis on all of them. And when something that you find out there is counter to my thesis, point it out to me proactively, and don't let me interact with you again until I've cleared that within my own thesis. So I have to write something in there on why I'm still highly convicted, even though something's super counter to that thesis that you found externally.
Interesting.
And he's going through all of this. And he says, every day I keep adding more and more and more into Claude so that it can keep being a better assistant to me. And I use 5 or 7 sell-side research. It automatically goes into this inbox. Claude can scan that, tell me what's most useful, not useful. And so the ultimate 10 to 15 stocks that this analyst owns, he'll choose. But he's got a much better system to help scan the world and have him be highly focused on those 10 to 15 stocks and put together names that he might not even be thinking about.
Right.
and say, why aren't you looking at this? And he said, the other thing was, cheap is not 10% cheap. That doesn't mean anything to me. Cheap is a statistical measure. Is it 1 or 2 standard deviations cheap? And so it might look through all the research and say, this isn't one of the 15 stocks, but it's in telcos, it's in Africa, it's statistically cheap. Why don't you own it? Now, he may say, that's a terrible company. I met with the management and they're a bunch of crooks. I don't know why he might not own it, but at least it pushes it forward to him to say, have you thought about it?
Right.
And so it's just, I think this is going to be a good companion for him while he's still making the ultimate decisions.
Right. And Mike, you mentioned the key man risk or key person risk earlier on. You said obviously that Capital Group is all about a team, and it's not all the decisions that Capital Group makes. It's not just about you have a big leadership team. What are some of their priorities coming into this year?
Yeah, I mean, look, if we can stay focused when others are distracted, we'll probably deliver a lot for our clients. The hardest thing to do when you have the industry going through such rapid change, your company going through change with technology, you have geopolitics that are upsetting and causing greater volatility. The hardest thing to do is to stay focused. It is. It's just the world. And then you have the phone, which just creates havoc. So between the havoc created by staring at your hand phone, to what's happening in the world, to what's happening in the industry, to what's happening at your company, if you can stay focused on clients and you can stay focused on generating results, you are going to win. And so our message that we send to our people is we have a super strong balance sheet. We're not going to be acquired. We're not going to acquire. And we're going to have the resources to invest in our business on behalf of our clients. That's it. The temptation for anyone in my seat is to massively overmanage the business because that's your job. Well, I'm CEO. I better do CEO stuff today. Well, what does that mean? And so to not massively overmanage the business and let people, ask them what they need to be successful, ask them how you can help, and let them have the freedom of mind to be able to execute, you're going to have a lot better chance to generate good outcomes.
Wonder what's CEO stuff?
Oh, that's a good question. I think doing this.
Look, we're running out of time. I did want to close it off by allowing you to provide some advice to our advisors and gatekeepers here in the room with regards to how do they deal with the uncertainty that we're seeing in this market today. It's very volatile out there. What do you recommend to our audience here? Yeah,
it's interesting. We have a strategy that just celebrated last month its 100th anniversary. And our founder took this strategy over after the Great Depression. So we didn't initially manage it. It was managed somewhere else. And after the Great Depression, the strategy had lost 90% of its clients and assets, the strategy, Investment Company of America. And they called him and said, can you take it on? It was $3 million in 1933, in the midst of the Great Depression, having lost all its clients and disappointed people. He took it on, and it was just after Capital Group was founded. And today, that $3 million strategy is $180 billion, and it's generated 11.5% annualized returns over 92 years. And it's beaten the benchmark by over 100 basis points annualized over 90 years. 170 million in the S&P 5. You take 10,000 bucks into that, you'd have 170 million in the S&P 500, which is pretty good, I take it. You'd have 460 million in Investment Company of America just by staying invested and by generating that excess return. And the most interesting thing about this strategy is it points to one thing that happened every single calendar year over those 92 years. This war, this recession, this pandemic, this financial crisis, there was always something that happened, and there was always a reason to be afraid, and there was always geopolitics, and there was always volatility. And it just kept climbing the mountain. And it comes down a bit, and it goes up, and it comes down a bit, and it goes up. And I always like looking at that chart. And I had a lady who's an advisor in the US come up to me at a meeting. And she said, I have to tell you this story. I have that chart put on my hallway in my office, the whole hallway. And I have a prospective client come in, and I tell them the story of this investment company of America. And I walk down the hallway and talk about the importance of staying invested in long-term thinking and not getting sucked into the volatility and the noise of the day, and the importance of long-term outperformance relative to a benchmark. And by the time I get to the end of the hallway to the conference room, I have a new client, and so does Capital Group.
You heard it from Mike. Stay invested, friends. Before we move on to live Q&A from the audience, I did want to get you a little bit loose and warm.
I'm already super warm. But go ahead.
A little bit
what
warmer.
do you got?
So I'm going to do a couple quick rapid fire questions, if that's okay. Mm-hmm. They'll be quick, and then you all will have the chance to ask Mike some questions. So let me start with something we talked about already, about AI, but this time from an investment thesis point of view. Is it short-term hype, or is there a long-term thesis there?
Long-term, absolute game changer, no question.
Equities, US or ex-US?
Both. Don't worry about where it's domiciled. Worry about the company, the business, the moat around the business, the nature of their customers. Where it's headquartered is much less important, and there's 53,007 public companies, not 7. So invest broadly, and don't worry where it's domiciled.
Mike, I really appreciate you being here today and joining us, and we had a wonderful conversation, and I know the audience really enjoyed the conversation with you. And for those of you here in the audience, I did want to thank you for making the time coming here to see us on Buyside Views. And for those that couldn't make it here in person, thank you for joining us and tuning in. Until next time.